All right, let's jump right in. Tackling IND AS 40 on investment property is kind of like playing a video game. It's one thing to learn the basic controls, buy a property, rent it out, do the accounting. But to really win, you have to know about the hidden levels and the tricky boss fights. And that's exactly what we're doing today. We're going to uncover those secret traps that can catch even the most seasoned pros completely off guard. So, what are these hidden traps I'm talking about? Well, believe me, these aren't just hypotheticals you read about in a textbook. No, these are the really tricky, real-world situations that can totally flip a company's financial statements. Honestly, knowing this stuff is what separates a good accountant from a truly great one. So we're going to break down the 6 trickiest nuances of IND IS 40. That's the Indian accounting standard for investment property. We'll go through them one by one. And I promise, by the time we're done here, you'll be able to spot these issues from a mile away and know exactly what to do. So let's get into it. First up, we've got the insignificant threshold. This trap is so sneaky. It pops up when you have a dual-use property. Let's say a building where you use a small part as your own office and you rent out the rest. The accounting for the entire building actually hangs on this one single subjective word. So what does insignificant even mean? Well, this is where it gets really interesting. The standard doesn't give you a nice, clean number like 5% or 10%. No. Instead, it just says you need to use management judgment. And as any accountant will tell you, management judgment is basically code for watch out, potential trap ahead. And just look at the huge difference that one little judgment call can make. If that office space you're using is deemed insignificant, then the whole building gets treated as an investment property under IND AS 40. But if it's significant, say you're using 35% of it, the entire asset flips over and becomes owner-occupied property under IND AS 16. I mean, we're talking about 2 completely different accounting standards, all hinging on one subjective decision. It's wild. And that whole idea of how you use a property, well, that leads us perfectly into our second trap, the very fine line between providing services and just being a passive investor. If you get this wrong, you could misclassify the whole asset. Okay, so here's the key thing to remember. If you're only providing really basic stuff like security or some general maintenance and cleaning, you're probably in the clear. The building is still an investment property because those services are just minor ancillary things. You're just maintaining your asset, not running a full-blown service business out of it. But here's where the nuance really kicks in. Take a hotel, for example. You'd normally think, oh, tons of services for guests, that has to be owner-occupied property. And you'd usually be right. However, what if you, the building owner, just lease the entire hotel to a big hotel chain, and all you do is collect a fixed rent check every month? In that case, you're just a passive investor. You have zero exposure to the hotel's day-to-day business. And in that very specific scenario, even a hotel can be classified as an investment property. See? It's all about what your role is. Okay, time for trap number 3. This one is a classic. You see it in exams all the time. Properties that are leased between companies inside the same corporate group. This is where your perspective, whether you're looking at one company or the whole group, changes absolutely everything. Okay, so check this out. On the subsidiary's own books, the building is an investment property. Makes sense, right? They're earning rent from it. But the moment you zoom out and look at the consolidated financial statements for the entire group, the picture completely changes. From the group's perspective, it's just one part of the company renting to another part. That internal rent disappears in consolidation, and all of a sudden, that same building is now classified as owner-occupied property. 2 different views, 2 totally different accounting treatments. All right, let's talk about trap number 4. This one's a really practical, real-world problem that Thankfully, the accounting standards have a pretty clever solution for. What on earth do you do when you have to replace a big part of an asset, but you have no idea what that original part cost in the first place? Just imagine this. You own a building, and you have to replace a roof that's 30 years old. Now, the accounting rules say you need to de-recognize the carrying amount of the old roof. But seriously, who knows what that specific roof cost 3 decades ago? The records are almost certainly long gone. Good luck finding that invoice, right? And the solution here is just beautifully practical. The standard basically says, hey, it's okay. You can use the cost of the new part as a reasonable estimate for what the original part must have cost. It's a common sense proxy to fix a messy, real-world problem. You're not expected to be an accounting historian. You can use today's cost to solve yesterday's accounting headache. Now for trap number 5. This one deals with how you account for something unfortunate, like a fire or a flood, and the insurance payment you get afterward. The temptation here is to just net the two things off, but that is a big mistake. So here is the golden rule. You absolutely have to burn this into your brain. Do not, under any circumstances, just subtract the insurance money from the asset's loss and report one single net number. Why? Because they are two completely separate economic events, and you have to treat them that way to show a true picture of what actually happened. So the correct way to do it is this clear 3-step process. First, you recognize the full loss from the damage in your profit and loss right away. Second, you account for the insurance payout as separate income. And third, and this is the part people often forget, you only book that insurance income when it becomes receivable, meaning it's virtually certain you're going to get it. That could be way later. The timing here is absolutely critical. And that brings us to our 6th and final trap. This one is all about action versus intention. You might have big, amazing plans for a property, but in the world of accounting, plans and intentions just aren't good enough. This quote from the standard is so powerful. You can't just have a board meeting and say, okay, team, as of tomorrow, this investment property is now our new corporate headquarters, and then change the accounting. Your intention to change its use means absolutely nothing without proof. So what actually counts as proof? Well, you need something we call objective evidence. This means things you can actually see, touch, and verify. For example, have you actually started moving employees into the building? Have you literally broken ground on a new development project to sell the property? Has a new tenant signed a lease and actually started their operations? These are the kinds of actions that actually trigger a change in classification. So the takeaway here is super simple and absolute. When you're talking about changing a property's use, objective evidence is everything. Without it, the classification stays exactly where it is. Period. And there you have it, the 6 hidden traps of IND AS 40. Really getting a handle on the insignificant threshold, that line between active and passive services, the group reporting conflict, and the rules on replacements, compensation, and objective evidence, this stuff will give you a major professional edge, whether you're sitting for an exam or sitting at the boardroom table. I'll just leave you with one final question to chew on, which takes us all the way back to that 3rd trap. Does the logic of treating those intra-group leases one way on individual books and another way on the consolidated statements, does that really make sense? Does it reflect economic reality? It's a great question, and it really gets to the heart of why we even have consolidation accounting in the first place. I hope this was helpful for you, and thanks for tuning in.